All right, welcome to Tax Tuesday. My name's Toby Mathis.
Elliot Thomas.
And if you're here for Tax Tuesday, you're in the right spot. First off, if this is your first Tax Tuesday, give me a thumbs up. And I'll see where they go. Any thumbs, any thumbs. So if you've never been to a tax, oh, there we go. So for a few of you guys, this is going to be your first one. Where's the little numbers? I'm trying to see. Maybe if I do this. Oh, there we go. Now we can see some people. All right. Technology, guys. But if you, here's another way to ask it. If you've been on a Tax Tuesday before, give me a thumbs up. That way we know we get three thumbs no matter what. No, there's a whole bunch. There's Sherry. All right, there's a bunch. All right, so we got a bunch of old school. All right, then I'm not going to waste a whole bunch of time explaining what Tax Tuesday is, but we are bringing tax knowledge to the masses. We answer a bunch of questions, which we'll go over here in a second. And then we answer questions that somebody emailed in, and then Elliot here selected, and we'll see how you did this week.
Right.
We'll see what he's got in his gumbo of whatever it is that we're going to be looking at. Yeah, this is fun. And then you guys can always ask questions, and when you ask questions, I'm going to say, please go into the Q&A and ask it. If I ask you to respond to something like, hey, is this ever happened to you? I usually tell you to give an emoji, or you could put it in chat. But if you have a question about your tax situation, we have a bunch of accountants on and tax attorneys. So I'm just looking at it. I see Patty, Matthew, Amanda, Jeff, Troy, Rachel, Arash, Dutch, Tanya. Like, we have a whole bunch of accountants, CPAs, attorneys, and so on. Like, we just got a lot of folks that are there to answer your questions. So you can go into Q&A and ask them. Now, if you get into like real deep details on your situation, or you start asking us to do tax prep, we're going to invite you to become a client, right? It's not what Tax Tuesday is. We're not going to do your stuff. If death by 1,000 paper cuts, right? So we will answer your generic questions. So if you have good questions like, hey, this is a scenario, what would be the outcome? You could ask that. But if you say, hey, I'm doing my 1040 and here's this and this and this, where would I put that? Oh, you should become a client. Don't do your own taxes. There, said it. Oh, by the way, you can always send in tax questions during the 2 weeks when we're in between sessions. You just send them on in to taxtuesday@andersonadvisors.com. We see it, we try to respond, and then we also pick questions that we will read and answer live. Speaking of which, let's go over reading some of these questions and answering them live. So these are the ones that we are going to answer live today. I'm not going to answer them yet. Just going to read what they are, and then we'll go through them. What are the basic principles to keep in mind with gains derived from investing in crypto? We'll answer that one. Is there a legal way to sell a property through a charity to avoid a capital gain and have the charity provide us with a small monthly retirement amount? All right. My fiance and I purchased a property together. He is selling his property that he has owned for over 10 years. We are not married yet, but intend to get married this year. If we get married after he sells his property, can we still claim status for capital gains? He will have a significant amount of capital gains on his property. His property will sell in August, and we weren't going to get married till October. We just want to make sure we're okay to claim status for capital gains. Good reason. Hey, I don't know if I want to get married just yet because I got the 121 exclusion to worry about. That's a good one.
Right.
Anybody who has an objection, the accountant goes up and says, well, it could cost you some gain exclusion. No, that would be a weird wedding. We'll answer that. All right. I purchased a duplex and will list it as a short-term rental in August. Congratulations. I want to buy furniture and supplies and do both major and minor repairs before the listing is active. Can I write off these expenses before the Airbnb listing is active? Yeah, good question. I bought an investment property for $260. It's only worth $200. If I sell it, can I take a $60,000 loss? Ouch. We'll answer that one. For short-term qualification, do we need to add it to Airbnb or Vrbo, or can we just rent it out to friends and family for 3 rentals of less than a week and still qualify for the deduction? If yes, how do we show proof? You guys are just, where did you go? You're like trolling for like,
They were really looking for some edge on the.
man. Can you reimburse medical costs if organized as a C-Corp? That's fairly straightforward. Can I make renovations to my personal residence to establish an Airbnb and write off the costs? We have a lot of Airbnbs.
Popular topic.
What is a backdoor Roth? I don't think we can answer that on the air, can we?
Not going to touch it.
Elliot will explain that one with pictures. All right. What is, could do balloon animals. Show you how to do a backdoor Roth. All right. What is a good way to, to plan when converting a primary residence into a rental property? All the dirty minds out there. There is a backdoor Roth. I can't read anymore. What is a good way to plan when converting a primary residence into a rental property and have a tax-wise setup for the transition? Do we sell the property to the LLC or transfer assign the loan to the LLC? How will the capital gains be treated? I just like it's just a funny, I'm gonna backdoor Roth here. It just sounds untoward. It's a tax term.
Dirty accountant.
Dirty accountants. Oh my goodness. I used to have a few accountant jokes now. I think they're done. All right. Hey, if you guys like these types of questions and you have an inquisitive mind and are always trying to learn more about tax and asset protection, feel free to join my YouTube channel. You could also grab Mr. Coons. He has a great channel as well, mostly on asset protection. I tend to do more the tax side. Together, we give you a pretty good coverage of what it means to be an investor and as many things we could think about. I'm just looking at this right now. Look at that. I see why savvy investors use land trusts for real estate investments. Look at that. So that's awesome. Miss Robbins joined me for that one. So anyway, feel free to jump onto the YouTube channel. It's free. Subscribe and fill your brain up with as much of this stuff as you can. It does pay off. As cheeky as we are and as much we seem to enjoy it, it's because it should be fun. Taxes should not be a horrible endeavor. It should be, hey, there's incentives and I like taking advantage of the incentives. Yes, when I get one. Boo, when I don't. But we'll teach you, both ways. Other thing, tax and asset protection workshop. When's the next one coming up? It looks like Tuesday, August 6th. So from a week from today, you could spend a day with Clint and myself, or maybe Clint. I don't know if I'm doing that one. And you can learn all about asset protection, LLCs, series LLCs, land trusts, corporations, different tax treatments, real estate tax, accelerated depreciation, cost segregation, and how to plan a legacy. Then there's another one, August 17th. And we have a live event in San Diego coming up, a 3-day workshop. If you have not done those, click on there. They're very inexpensive and they're a lot of fun. And it's always fun to get together with everybody, especially a bunch of investors. Not only are you guys fun to hang around, but when you're around people that do what you do, it's kind of cool. And you learn something just through osmosis of what these guys are doing. It's always kind of fun. What else we have? Some of this. Somebody was talking about IRS agents when we were talking the backdoor Roth. No, it's not it's not a tax treatment. It's not a penalty for failing to pay things. The agent comes over. All right. What are the basic principles? You might feel that way. I've seen that way. You're like, what the heck are you doing to me, agent? What are the basic principles to keep in mind with gains derived from investing in crypto?
Well, I think the first thing to start the basics, crypto is treated as kind of a personal asset to sell of. And so if we have gains, we kind of know we need to know how we got the gains. If we got it from staking and things like that, staking is basically where you've used crypto that you have to create more crypto. That is ordinary income. Not only ordinary income, but it's subject to employment tax, depending on the type of staking and things like that. Or if you just have crypto, you went out and bought some Bitcoin and you sold it maybe a year later, well, it could be capital gains. So we really want to know which we have, could have a little bit of both. We have a lot of clients who have both going on. And we will, when available, we'll try and treat it accordingly and put it in the best structure for that. But that's, I think, the basics you need to know is that there's some that's ordinary income, you're staking, and then the rest is in capital gains would probably be a good place to start with your basics on that.
Yeah, I'm going to back it up even further. There's people that are out there with their computers and they're generating crypto, and that's mining, and that's ordinary
Yes.
income. You generate the ordinary income. There's another way to generate ordinary income, and that is to do the staking. So mining and staking, anything with an ing on it, sounds like it's going to be
Action.
ordinary income, and it's active. When you're doing the mining, if you're actually mining and you materially participate, then you could be looking at even employment taxes, I believe. If you spend crypto, so if you invest in crypto and sell crypto, it's capital asset. So capital gains, you sell it within a year, short term, you hold it for over a year, long term. If I trade, like, let's say this is a Bitcoin and I trade it to Elliot for, I don't know, his glasses or this pen. There we go. We'll trade it for a pen. What actually happened is, for tax purposes, I sold the crypto and then I bought the pen. So there's a taxable event. I sold the crypto. So whenever you spend crypto, you're engaging in a taxable transaction, period. Right. And that's what trips people up, because they'll go, hey, I made some money on my Bitcoin. I went and bought a car with it, or I went and I bought something with it. That's taxable. It's taxable as though you sold the crypto, turned it into US dollars, and then purchased the item. So as a principle, there's no free lunch with crypto. And just knowing when is it ordinary, when is it capital, and why the heck is it so complicated? Because it just kind of is. It's kind of a interesting phenomenon. Massive amounts of gains. I was doing a video earlier today, and I was going over US dollars versus other asset classes. And, here's a fun one. In 1980, if I had $1, it's worth 25 cents today, purchasing power. If I had $1 of crypto, it's egads. It's worth about $870,000 today. And that was in 2010. And like, that's freakish, obviously, right? But I think we're through the crazy, hey, it's a new technology that came in and a lot of people were, got their windfalls, but I don't see that continuing to do that. I mean, that would be crazy if it did. I'd be happy, I suppose, but it would also mean inflation's gone nuts. But when you compare those, oof, like, oh my gosh, US dollars just been stinky. And then you look at these asset classes, and I don't care whether it's stocks, real estate, bonds, crypto, real estate, all of them just blow the heck out of those dollars. All right. So the basic principles, I think we covered. There's also forking. You're talking
With crypto.
Yeah. So you could have a soft fork, hard fork. Hard fork creates taxable income. Soft fork, I believe, doesn't. But if you're a crypto person, those terms might mean something to you. If you're not familiar, then you're like, what the heck is that? It's when you get extra coins. Sometimes they give you more coins, but you don't want to be in a situation where you have a taxable event and you're like, gosh darn it, I didn't realize I was incurring a tax. And especially for those that are out there mining, they don't realize you're allowed to subtract off your electricity and the costs involved in mining, but a lot of times they're tripped up because it's not like, hey, it's not like you got US dollars sitting in your bank account and you're like, oh, that's what I made. It becomes this, how the heck am I tracking it? How am I taxed? What price point do I pay? How do I track for these things? It gets complicated pretty quick.
Yeah, and just to that, yeah, I think the tracking, the accounting for it is going to be fundamental. That's where there's a lot of challenges in the industry, how to track your gains, what your original basis was, gains, et
Huge.
cetera. Software is catching up, but it is a different beast, and there's so much turnover. Many times people changing over their positions all the time. So it's something that have the best software you can find for the accounting of it.
Yep. I remember when it started and we were like,
Yeah, that was
we don't
terrible,
know.
right?
We're not touching it. Like,
Mhm.
because we didn't even know how they were going to treat it. The IRS finally gave us some guidance. Then we're like, okay. But it was a bit of a mess for everybody. Is there a legal way to sell property through a charity to avoid a capital gain and have the charity provide us with a small monthly retirement account? So,
Kind of a loaded question. Now, I'm assuming that we have the property in the charity already. I would not recommend selling a property necessarily to your own charity. So, you don't really own a charity, but there's that really, and it's not really a related party, but it can be collapsed, I think, by the IRS, something like that. But assuming the properties are already in there, it can sell. Certainly, and you wouldn't have to pay tax on it necessarily, depending on how they use the funds and things like that. I guess we'd have to get a bit more into the nonprofit.
yeah, I mean, so let's say you have a house that you paid $100,000 for, and that maybe it was an investment property, and 10 years later it's worth 300,000. And you're thinking, I want to sell this, but I don't want to pay the tax. So you have a few choices, right? You could 1031 exchange it, trade it for more property. Maybe that's not where your mind's at. Maybe that's not what you want to do. Maybe you have losses from other properties that you could use to offset the gain. But maybe you don't. And then in which case you're like, oh shoot, I'm going to have a big gain. So how do I avoid this gain? And what I really want is to have some certainty in life that I have money coming in, but I don't need all the money from the sale. You could donate it to a charity and take a fair market value deduction. If it's a public charity, like you set up a public charity, it's what we usually do. You would get a 30% of your adjusted gross income tax deduction. You'd carry forward any unused amounts going into future years. So in English, I bought the house for 100. I could sell it for 300. I donate it to my charity. I get a $300,000 deduction. The charity sells the property and now it has $300,000 and there's no tax due on it. Now, the next part of this is, well, but I kind of need money. Well, it can't give you a income stream where it just says, hey, here's an income stream, because that would reduce the fair market value. I mean, I suppose you could say, hey, I'll give you the property, but I want money back in return. That sounds like an installment sale to me. And so you'd have to calculate it as such. But what you could do is say, hey, I'm giving it to my charity and I'm going to take a salary out of the charity and I'm going to take a small amount per year, but the charity has to do something. If the charity doesn't do something, it's going to become a private foundation, still a charity, just not a public charity, in which case it has to give away 5% of its assets every year. And you could still take a salary out of that. You could still get some benefit. So just giving you some options. If you already have a private foundation, you could still do this transaction as long as you gave the property to the private foundation. It's limited to 20% under those circumstances of your adjusted gross income. So Elliot here, let's say he makes $500,000. He's got this $300,000 house. He gives it to a public charity, his own that he sets up, and it's going to do low to moderate income housing, or it's going to do teaching people accounting, and fill in the blank. And he makes $500,000. He would get a $150,000 deduction, 30% of his adjusted gross income. His adjusted gross income is 500, so 500 times 30% is 150. He'd use up 300 of the deduction this year, and then next year he'd get the other 150. Flip it around, and Elliot has a private foundation, and it's all it does is give money to other charities. He donates the house, still a $300,000 house, but he's limited to 20% of his adjusted gross income. 20% of his 500,000 would be 100,000. So it would take him 3 years to write that off, but he would still get the deduction. You would pay tax if you took a salary out of those things, but that might be a way to get to where you're thinking of it. But otherwise, that looks like an installment sale, which would reduce the amount of your deduction, which may or may not matter depending on your circumstances. Now, this is where I put the caveat. Gets complicated quick, right? You have different options, which is why you talk to somebody. It's why you reach out and you say, like, hey, this is my situation. What can I do? You want to have somebody who actually knows what they're talking about so that they can actually calculate it.
Her name's Tanya.
Her name's Tanya. Give all the really difficult ones to Tanya. Does that make sense, guys? Give me a thumbs up if that makes sense to you. See if anybody's listening out there.
There we go.
There's a few. All right, good. All right, so we're tracking. And by the way, I never talk about this, but if you ever wanted to become a client of Anderson and you just want a strategy session where you're sitting down with somebody, just anytime during the Tax Tuesday, just write, I'd like a strategy session, right? Somebody will hook up and you meet with an advisor. I know that kind of sometimes it goes without saying, but I want to make sure that you guys know that you always have that possibility that you could just say, hey, I don't want to go through Q&A. I don't want to go through chat. I just want to talk to somebody. All right, put in there. And then we'll have them talk. Anywho, let's keep going on. Anything else on that one? I could talk all day about charities. It's a problem. My fiance and I purchased a property together. He is selling his property that he has owned for over 10 years. We are not married yet, but intend to marry this year. Congratulations. If we get married after he sells this property, can we still claim status for capital gains? His property will sell in August, and we weren't going to get married until October. We just want to make sure we're okay to claim status for capital gains. What say you?
So I think what we're getting at here is the Section 121 exclusion. We've talked a lot about that. Excuse me, that's on an exclusion on the sale of your primary residency if you meet basically 3 criteria. Number 1, you have to have lived in it for 2 of the last 5 years. You have to have owned it as your personal residence for 2 of the last 5 years, and you can't have taken a 121 exclusion within the last 2 years. And what 121 says is that if you're single and you sell your primary residency, you met all those conditions, you can exclude up to $250,000 of your capital gains. If you're married filing joint, though, you get $500,000. So when we're looking back here, we really just want to go down that formula. Do we have the use, the ownership? And it doesn't look like we've probably done a 121 in the last 2 years. Here, it depends whether or not our the individual asking the question was living in that house as well with the fiance. If he or she was not, then the fiance is the only one who met the ownership and use 2 years out of the past 5 years, and it was sold under these fact patterns before they got married. So what's going to happen later on, even if they marry that same year and they marry filing joint, there's a provision in the regulations that say under this circumstance, he'd be the only one who get the 250,000. We treat it as if he was single. You treat each of them as if they're all in status towards that test. And our questioner here wouldn't have any status here. But if they live together, well, now we do have use. We probably don't have the ownership, but the ownership is a unique one in that you just have to have one party, I believe, make it.
When you're married filing jointly and you sell a property during a tax year, doesn't matter what month, during a tax year, your ownership is imputed to your spouse. So under these facts, if they sell the property, and I'll just say fiance 1, and then they get married, then the ownership test 2-year period is satisfied by the fact that during the taxable year in which they filed married filing jointly, they would impute to the other spouse, even though spouse 2 was never on the property, right? It'd be like, again, if myself and my wife, if Sandra was on our property and I was never on it and we sold, as long as I lived in it with her for 2 years and we were married filing jointly, her ownership's imputed to me. Now, under these facts, we don't know whether they lived together for the 2 years, right? So we don't know. It looks like they did not because they bought a property together, probably to move in, but I don't want to assume that. If they did live together and they satisfy the 2 years, then even though they got married after the sale, it's the tax year, the ownership requirement would be satisfied and the use requirement of 2 years would be satisfied. then the only other thing that would be of issue is, did anybody sell a property and claim 121 exclusion and in 2 years,
Mhm.
within 2 years, because that would be straight up, can't do it. But under that circumstance, you could get a $500,000 exclusion.
Yeah. So we're gonna get savings on our capital gains here. It's just a matter of how much.
What he says.
I do some bad questions in here, especially that Roth.
I don't even want to talk about the Roth and I want stuff. Jiminy Christmas. Feel dirty talking Roths conversions. All right. I purchased a duplex and will list it as a short-term rental in August. I want to buy furniture and supplies and do both major and minor repair. I don't know what that means. I want to do some major and some minor repair. I just want to do repairs. Like, I think you cover it all. What else is there? Major and minor. What's not covered by those two categories? Right, just repairs before the act. I'm just teasing. Before somebody got mad at me once, I was poking fun at what they said. Like, they really got mad. Okay, I want to buy furniture and supplies and do both major and minor repairs before the listing is active. Can I write off these expenses before the listing is active? Yes or no?
So
Can you? Look at you.
uh, generally speaking, no, you're not gonna write it off before it's active. If the furniture's part of the, kind of the
You
whole,
can't.
yeah, you can't.
It's no.
Well, we do have clients.
Tried to get an accountant. I
now
tried to get a tax attorney to answer something yes or no.
that's your real struggle in life there. But we do have clients that they have furniture, they keep it in a warehouse and they may rent it to these certain, that would be a business. And now you have a whole different situation, but that's unique. But there you would be able to deduct that because it's a separate business. But that aside, and we take the normal run of the mill, I just got a building I want to rent out, I put the furniture in it. You're not going to do anything until you put it into service.
But here's the thing. So you got to have the property into service before, or the business started, right? Otherwise, you're looking and you have rules, what is it, 195, startup expenses and things like that, but this doesn't qualify. Realistically, what this is it what, 5-year property furniture?
I think,
So we're gonna start writing it off. Boom, the day that we start. You can bonus that or you can 179 it. So you're gonna get to write the whole thing off in the year. But you're not supposed to write things off until you actually start your business. This is going to play into one of the other questions because I saw, hey, what should I do first? A lot of people put things into service early. Like if you're a savvy investor, a lot of times they're like, let's just put it into service, then we'll rehab. And you're like, why would you do that? Because I want to start the clock ticking for depreciation. And then the accountant might say, well, did you take it out of service to do the rehab? Like, you're like, no, we're just going and we're going along the fly, right? And we're trying to start the clock. So here the clock doesn't start until August, until it's not when they actually rent it, it's when it's available to be rented. So ready and available. So you're not going to get to write off the furniture as you're buying it. You're going to write it off this year more than likely, but it's probably going to be a accelerated depreciation. You're going to be writing it off as a depreciable item. What would that be under? Would it be like other expense, or where would that be hiding on the return?
We would typically, if it was going to be Schedule C, you would just deduct it. Normally, you just put it under depreciation. Just put it under there, yeah.
Equipment.
Yeah.
All right. I hope that's clear for you guys, right? We see this come up all the time. People are like, I'm fixing things up. So like here they have minor and major repairs. That's depreciated as part of the structure. If it's a repair, to put something back into, if you're just fixing something, then you might be able to write it off under the, what's $2,500, the de minimis. Yeah. So if you're doing major, you're probably amortizing it, spreading it out, but you could still do a cost seg. And especially if the major repairs are like, hey, I put in some appliances and rewired them and added new plumbing. If you do a cost seg, that appliance is a 5-year item, and anything attached to it is 5 years. So any of that work you did might be 5-year. You can bonus depreciate it. You can accelerate that depreciation. which is why accountants, a lot of times when they're looking at scenarios, they're saying, hey, do you want to look to see if we could do that? You get a lot more deduction up front that way. Anything else on that?
Nope.
I bought an investment property for $260,000. It's only worth $200,000 now. If I sell it, I can take a $60,000 loss, question mark.
So pretty straightforward answer, but there is a little bit of, well, it kind of depends. If we bought it as investment, we're saying maybe it was a flip or something like that, and we take it a loss. Well, that could be an ordinary loss. So yeah, you're going to be able to take that. And typically an ordinary loss will go against any other income that you have on your return. But if it was maybe a long-term asset, kind of like the Bitcoin, we were talking about crypto earlier, there it's probably going to be a capital loss. And in that sense, while you can take a $60,000 loss, you might be limited by the capital loss rules, which say you can deduct that loss against any other capital gains up to the 60,000, or if you don't have that going on, you can take 3,000 like the ordinary loss for the next 20 years, and it would take some time to use that up.
Yeah, one other thing is you got to do the adjusted basis. So you got to look at like the things that would change this scenario is, hey, I put $20,000 into improving the roof or replacing the roof, things like that. You might have taken some losses. There's some things can move the calculus, but if you just bought it and sold it, then generally, yes. If you end up with depending on what your basis ends up being, because you could add, you could subtract, and especially if you depreciated, then
Yeah.
then we might see a different number. But generally speaking, this is how it works. If it's an investment property, if it was your home, then you get nothing.
And just to that, just so you understand, what if we had been a rental, we had some depreciation. Let's say that the 260 is our adjusted basis, or well, we sold for 200, but our age adjusted basis with 260, so we have the 60 loss. There's no depreciation recapture with a loss, so you don't have to worry about that one. You don't have to worry about what part is ordinary, what is capital. That only comes in if we have a gain.
Yes. Trying to think if there's anything I could. Nah, there's nothing I can put. Nothing on this one. I'm looking at all the cool ones. I've got Wilhelm Scream. I will save that one for a good time. All right. For short-term rental qualification, do we need to add it to an Airbnb or VRBO? Or can we just rent it out to friends and family for 3 rentals of less than a week and still qualify for the deduction? If yes, I have no idea what they're talking about here, because over what period? Can we just rent it out for 3 rentals?
Yeah, we get asked this kind of thing a lot, so you start to read into the question a little bit, maybe more than we should. But first of all, there's no requirement that you specifically set up an Airbnb or VRBO. I'm not ready to get bounced by the music machine yet. And but as far as renting out to friends, that's a no-go. Okay, we can't rent out to our friends or family and things like that. In fact, you can't even, well, if they're unrelated friends, I should take that back. I've had clients come up and say, well, yeah, they're my friends, but they're also my business partner. Well, that's a related party through your business. There's a case out there that you might find where they talk about the family tried to rent to the sorority of the child. That doesn't count. That was a related party in that instance. So if you do rent to a related party, what's going to happen? That's considered personal use. You have too much personal use, you can't take deductions above whatever your rental income was for that year. So you don't get that massive deduction. That's what we're talking about here as far as the deduction.
It's the 14 days or 10% of the rented days.
Yep.
Right. So if you hit those thresholds, then you can't take a loss. And when you're calculating your personal days, you add in related parties to you. So it's your family or anybody that's an owner of the family. If it's just your friends, you probably could get by. But that's not what this is really about, right? This is saying, hey, do I have to list an Airbnb and VRBO? No. The test is, how many days did you rent this property out? And how many unique rentals were there? So to different parties. So it's not like I could rent it 7 days in a row and he calls 7, hey, each day is 1 day. No, I'm one person. I rented it for 7 days, right? So that's my rental. But I could add up the days. Let's say I rented a property for 200 days during the year, and it was 50 different bookings. Then I would have 200 divided by 50, and I would have 4 days average use. That qualifies it as a trade or business. Then the only question is, did I materially participate in that trade or business? If it's making income, do I have an issue with Social Security, taxes? Actually, probably not, unless I was providing substantial services in addition to just being an Airbnb, like feeding them or giving them concierge service or changing their sheets every day. If I was acting like a hotel, then they'll treat me like a hotel. Otherwise, no, that wouldn't be subject to employment taxes. But like Elliot just said, if you had losses, then you could treat that as an ordinary loss and use it to offset your other income, like your W-2 income. So that's why these Airbnbs and VRBOs are so attractive to doctors, dentists, or high income individuals, because they may have high W-2. And if they can get a property and qualify it as a short-term rental and meet the material participation tests, there's 7 of them that you only have to hit one, but usually they're managing it themselves. Then boom, they get that big deduction against their W-2 income. And sometimes it's worth the down payment on these things. You see it where they'll finance and buy a really nice property. The tax savings cover the down payment. So they're really out of pocket, zero. They're just picking up properties and they do it every year. We have like a few different doctors that buy it, buy it, buy it.
Yep. That's it.
Fun.
Oh, as far as showing the proof, just keep any kind of record, like an Excel spreadsheet of your rentals, the days, things like that would be fine. Some people use a calendar, anything like that.
It's up to you. Once you meet the threshold, then they got to disprove. You just got to show that you're doing it. Here's my little thing. I'm going to make this move forward. There it goes. Can you reimburse? Is that right? Oh, looks like we're just cruising.
Yep.
Can you reimburse medical costs if organized as a C-Corp?
Simple answer, yes. If you have a medical reimbursement plan, one of the easiest is a 105 plan. If we set up your C corporation, we pretty much, that's mandatory that we set that up for you, so it's available. It is a non-discriminatory plan, which means that if you use it for yourself and you have some other business, or in this particular business, you have employees, you have to extend it to them as well.
Yep.
Okay, so that's one thing you want to watch out for.
100%. But if it's just closely held and you have no other employees in any other of your other businesses, which is the big one, but you can't just set up a C Corp and be a greater than, what is it, a 2% shareholder. Most businesses, you're going to be, you and your spouse are going to be, you're going to have the discrimination rules attributed to you, which means, hey, I got anybody that I have as in my employee, even through other businesses, I'd have to offer them the same benefits, or I can't write it off. It's fun. Somebody was asking a question on short-term rental. Can you do repairs on your short-term rental and still have it available to rent? Yeah, absolutely. Can you stay in your short-term rental while doing these repairs? Yes, and it's not considered a personal day when you're doing repair. So remember the 14-day, 10%, which sometimes comes into play in Airbnbs because people like to stay in them a couple weeks, 3 weeks a year. And but if you're fixing it up, then those days count, not as personal days, but as rental days. All right, enough of that. Let's go back to talking about Clint Coons and the tax and asset protection workshop. Right, we have, again, if you want to learn different tax strategies, LLCs, plan trust series LLCs, I encourage you to attend one of our one-day virtual workshops. If you want the live experience, we're going to be in San Diego on, it looks like it's September, can't read for poo, 26th through the 28th. So September 26th to 28th, we'll be in restaurant or Hotel Circle, I think at the Town and Country in San Diego. Feel free to join us. They're always a lot of fun. Sometimes Elliot shows up, maybe on this one, but they're always a hoot. There's usually several hundred of us, and we get a chance to Yeah. Somebody says Clint is the man too. Don't. No, he doesn't need encouragement, Jerry. That's right. Sure. Why wasn't Elliot in Dallas? He was in jail.
Yeah,
Ah,
I was
sure.
answering for some stuff here.
Yeah.
All
No.
that backdoor Rothing.
Yeah. Just gross. His truth fell out. Yeah.
That's right. Yeah, I did have a tooth explode.
Yeah. All right, let's see. Can I make renovations to my personal residence to establish an Airbnb and write off the costs? Look at that. We got more Airbnb.
Yes, a lot. It was a big factor in all your questions this time. So yeah, of course you can. You can make renovations, and whether or not they'll be deductible would depend. Basically, does it have to do with the area that's being rented out, or is it with your personal living space? So, if you have one room out of three, maybe 30% of it's going to be used towards Airbnb. Probably 30% of those, if they're directly related to that area, you're going to be able to deduct that in some form, be it a write-off as an expense or depreciation, whichever it be. But the personal, no, we're going to run into the stuff that built up your personal residence. Probably not. That will add to your basis for your personal home, parts, but it's not going to be a deduction at that point.
I can't add anything to that. So renovations to my personal residence. Yes, you can, and write off the cost, depreciated over time. What if somebody did a couple repairs? You still have to put it into service before you write that off. Otherwise,
Yeah, I think we get back to everything we talked about earlier. Yeah. Yeah, it's got to be in service.
got to be in service. All right, enough of this. Now we're going to your favorite. God, I don't know why you picked this question.
Because it was a retirement. It was everything else was Airbnb. And
Mhm.
so what is a backdoor Roth? The idea is that we generally, if you make too much money, if you have too much income,
Painful, whatever.
you usually can't put into a Roth IRA. And why do we care? A Roth IRA grows tax-free. That's why we like it, as opposed to a traditional. Well, it certainly grows. It grows tax-free as well, but when you take it out later on, you got to pay tax. Whereas in the Roth, it grows tax-free, and later on at retirement, when you take it out, you don't have to pay any tax. That's why people like to put money in there. But the IRS knows that, the government knows it, and says, well, if you make over approximately, I can't remember what I said, it's 161 individually, 240 approximately married filing joint, they're not going to let you put money into a Roth, a regular Roth. So what people do is they put money into, I'm over that limit, I got all kinds of money, and it's after tax money. I already got taxed on my W-2 income. I'm going to put that into my traditional Roth called an after tax amount donation or contribution, excuse me. And then you can change it. You just convert it over into a Roth. That way you don't have to pay any taxes. It's already been taxed, but it gets the money into the Roth, and now it can grow tax-free. And later on, you can take it out tax-free.
Yeah, and they even have super backdoor Roths.
Yes. Yes, they do.
Jeez, Elliot. Horrible. Yeah, the super backdoor is when you're trying to put $69,000 a year into a Roth 401k. And yes, you can actually do this, and you overfund the employee portion. You write a check. There's basically three buckets. So I want you to visualize three buckets. 1, 2, 3. One bucket is the employee deferral, where I say like, hey, I could put $23,000 a year into this deferral bucket. The other one is where the employer can put 25% of your wage into that bucket. Those are both tax deductible. And then I have a Roth 401k bucket that is not tax deductible. And what you're doing is you're overfunding. I'm putting extra money up to the amount that I made this year. So I need to make 69,000, and I put 23,000 in there as the deferral, and then I add an additional whatever it is to make it 69,000. And then here's the magic. I do an in-service distribution from this bucket to the Roth bucket. I skip the employer side. So I boosh. How much is in the bucket for the employee deferral now? 0. How much is in for the employer contribution match? 0. How much is in the Roth? 69,000. I am not allowed any deductions at that point because I have no contributions in those buckets that were tax deductible. All of my money is sitting in a post-tax bucket for the 69,000. And you're allowed to do that. And there's no income limitation other than I need to have taken as at least the 69,000. If I wanted to do that with 25,000, I could do it. If I wanted to do that with 15,000, I could do it. But if you want to get a larger amount, like if you're one of those people that's like, hey, I'm okay with my tax bracket where it's at. I'm about as low as I'm ever going to be. And I want to get as much into that Roth as humanly possible so I can invest it and go nuts. And I think I'm going to be a higher tax bracket in the future. Then you use the super or the mega backdoor Roth. Otherwise, the backdoor Roth is kind of plain vanilla. It's just, hey, I wouldn't have been able to contribute to a Roth, so I put it in the traditional first. Some people say, well, can't I do that with a 401k? Yeah, you could put it in a 401k. You can convert it over to the Roth bucket in the 401k. Well, okay. But what if I don't want to do that? Well, then you could roll it into an IRA and then convert that into a Roth IRA. But here's the one thing. I'm just going to give you guys this, and I'm sorry it gets into the weeds sometimes. You can roll from a Roth 401k into a Roth IRA. You cannot roll from a Roth IRA into a Roth 401k. Just so you know, it's a one-way street.
Sherry liked it.
Sherry.
Oh.
She's doing there's all sorts of innuendos in this thing. Oh my goodness, you guys. So I won't even say what's coming to my head because it's not good. All right, moving on. Anything else on that?
Nope.
You just dirty tax strategies. Dirty. All right. What is a good way to plan when converting a primary residence into a rental property and have a tax-wise setup for the transition? Do we sell the property to the LLC or assign the loan to the LLC? How will the capital gains be treated?
Well, you could do either one. If we're going to sell, we often talk about, Clint's got a video out there about selling your primary residency to your own S corporation. That would be an option. One of the benefits to
Give
that.
them the scenarios.
Yeah,
They understand it.
absolutely. If we have a house, a primary residency, we've lived in it, and we go back to our previous question about section 121, we've been there over 2 years of ownership, 2 years of living in there, and we haven't had a 121 exclusion within the last 2 years. Then, and if the house has gone up in value, let's say Southern California, it's gone way up in value, since we first bought it, maybe you want to sell to your S corporation because you can take advantage of the 121, 250,000 single, 500,000, $500,000 exclusion. If you're married filing joint, you can take advantage of it because you're selling to a different tax reporter. That's your S corporation. Now, there are some caveats to that. Your corporation, if there is any additional capital gains, you got to recognize that right away in the year you sold. The S corporation can pay you that fair market value that it bought it at over time on an installment over time, slow installment payments, but you got to recognize the cash right away because it's a related party between you and your S corp. So that's one thing. Want to make sure your lenders are okay with it. I have never heard of a problem. We have clients who go and talk to the lenders, sell it to my own S corp. They typically don't have a problem, but I would check, especially in this era of they're hypersensitive to refinancing because of the higher rates. That's one way. If you have that big gain that's occurred with your property over time. If there's not much gain and you're not going to get a whole lot, of exclusion, you can just go ahead and basically put it under the LLC, assign it however you want to do it, a disregard LLC, and that would be fine. There isn't any tax consequence there. The only thing that could possibly come up that way would be maybe a transfer tax, but most states would not hit. Even Pennsylvania, I don't think would hit there.
Yeah, capital, they do.
They do? Oh, there you go.
Even when you put it into an LLC. So they're the only ones. Pennsylvania is horrible. They said, how are the capital gains treated? And I just want to be clear that when you contribute property to an LLC, it doesn't reset the button. It's actually getting your holding period. One of the drawbacks or benefits, depending on the scenario, is that it's keeping your basis, it's keeping your holding period. That's a big one. But like Elliot was saying, is sometimes you have somebody primary residence and there's the capital gain exclusion and they don't want to lose it. And you don't have to have lived in it the last 2 years before you sell it. You have to have lived in it 2 of the last 5 years before you sell it. So technically you have a primary residence that has some gain, you have 3 years to sell that puppy. And let's say that you've owned it for 10 years and you had a property that went from 200,000 and now it's 500,000. So you have $300,000 of gain. You're married filing jointly and you're like, oh man, I should sell my property, but I don't really want to. I'd rather just make it into a rental. And so you start renting it instead. You have depreciation that you're getting on the property, but it's on your basis. So I remember I bought this thing years ago at what, 200, and now it's worth 500. So you're depreciating it at 200. If you want to jump that up, that's when you sell it. You have to sell it to another taxpayer, and another taxpayer can't be your LLC, just you. It needs to be an S-Corp for tax purposes. So you could sell it. Boom, I'm selling it now to my S-Corp, just as you put it. I could carry it on an installment sale. I'm not going to get to tax it as an installment sale, nor would I want to. I want to opt out, and I want to grab that $300,000 of capital gain and recognize it in the year that I sell my primary residence. And the reason why is because we have a capital gain exclusion of $500,000 sitting there because we've lived in it for whatever it was, the last bunch of years. So I can write it. So I have no tax. It's now in an S-Corp, which is, some people freak out. Like, oh, if you take it out to refi it, you're going to have a bit of a tax hit potentially if you hold it in there for a long period of time. If you did it right away, it wouldn't matter because it has a new basis of 500,000. So boom, we have never going to pay tax on that capital gain. We now have $500,000 tax write-off minus the land, but a much larger depreciable amount, which is going to reduce our taxes. And we're still getting an income stream from the S-Corp. Like, the S-Corp didn't have to pay us. It's going to be paying us over time under the installment sale, even though it's not being taxed as an installment sale. You might have a little bit of interest you have to recognize, I imagine. Actually, would you? You probably wouldn't even have to do that. So you're just sitting there in a much better position. That's when you see that come up. It's rare, but you do see it. Otherwise, you're just like, hey, I don't want to sell. I just want to take my house and make it into a rental. Okay. Remember, the most important date is the in-service date when it's available to be rented. Then we could start depreciating it.
And that depreciation, as Toby said, will be at a, a higher level because of the stepped up. Likely that's going to flow through to your personal return because it's an S-Corp. And I bring that up because we had a question there on one of the chats about, well, why not a C-Corp? Well, you could, but it's not going to flow through because it's a C corporation. All the activity is going to stay on your 1120 tax return, your C corporation return, and you're not going to get that benefit of it flowing through that an S corp will give you. Norma had that question there. Yeah.
Okay, somebody's giving a scenario and they asked me to explain it. So I'm going to go over this, Amy. So you bought a property for $505,000. Right now it's worth 1.8 million. So we have 1.3 million in gain staring at us. I'm married and lived in it from 2019 to 2021. So we're really close to the line. Converted it to a rental of last year after being empty for 21 months. Okay, so if you want the 121 exclusion, assuming that you lived in it as your primary residence, so you're saying you lived in it for 2 years, you could sell this to your S-Corp and you would have zero, or you'd have a tax-free portion of $500,000. So there would be 700 some thousand dollars worth of gain. I don't know if I would do that.
Yeah, you're going to have to pay tax on that gain that's left. Right
What
away.
I would do if I was you, if I wanted to pay no tax on this and I just wanted to get it, get rid of it, is I would sell it under a 1031 exchange because you converted it into a rental. And you would get your 121 exclusion as well, as long as you did this within 3 years of moving out. So I don't know, converted it 21 months. Sounds like we're 3 months away. So 21 from July, so 3 months from July, so October. It sounds like, Amy, what I'd be looking at is 1031ing this. What will happen is you'll get your your $500,000 exclusion and would add to your basis, which is 505,000. So you'd have $1 million new basis in the new property or properties. You could buy a bunch of properties. You could split it up. You could do a Delaware statutory trust. Some of these companies do those. And with that, you would be able to avoid capital gains completely. You would have a higher basis and you'd have converted it into an income producing property. If you want to keep it, then you're going to have a pretty massive tax hit. I don't know a way around that. If you're going to keep it, unless you sold it to like a sibling or something, you could potentially do that where you wanted to keep it in the family, but pretty tough. I would actually have somebody map it out for you, but because you're turning it into a rental, right. Somebody says, I see my interest rate is 2.5. Yeah. You're balancing. Hey, $500,000 of capital gain that I'm going to lose. That exclusion was worth what versus, hey, I'm keeping the property with a really low. Amy, is the current interest rate high now? Like, or is you're at 2.5 now and you're just going to stay there? Is it a fixed rate? So that you're there. If your rental is under an S-Corp, can you still claim losses? Yes. Flows right down onto your return. It's really no different than a partnership, except that when you take it out, it could be taxable. So now the current interest is very high. Oh, so that I'd get rid of that thing. Like, I'd probably sell it and turn it into like 1.8 million. I could probably buy 10 rentals.
Yeah.
With that, at least I'd go shopping in North Carolina and Kansas City and in Indianapolis and Idaho and a few other places, right? I'd buy some income producing properties and not pay any tax and have a new high, really nice new basis. I'd have the $1 million basis, but I'd never have to pay tax on that. Locked in. Avoid the tax. So, oh wow, my interest rate, but the current interest rate is
6.8.
Oof, hurting my heart. Fun stuff.
4.3.
Oh, look at that. If you like fun stuff, you can go to YouTube and you can sign up and register. And I like it because then it looks like people follow me when you guys click subscribe. And I can tell Clint, dude,
What's wrong?
where's yours? No, there's over 800 videos. Like you could get lost in there, but there's a lot of good stuff. Tax and asset protection workshop. Don't miss that. And again, I said this earlier, but like Amy, this would be a good thing for you is reach out and have somebody, have a consult with you, make sure that, see if there's a way we can help you. I know she says I'm torn. I'm torn too. I feel your pain. It's some capital gain exclusion sitting there staring you right in the face at your interest, at your tax bracket. You're probably thinking, it's probably $125,000 decision just on that. But I like cash flow. And then you just reach out and see if somebody can talk to you. All right. Come to the tax and asset protection workshop. If you know anybody that could benefit from hanging out and learning about LLCs, or everybody has that friend that knows everything and they're like, my guy said just get some insurance. All right. Just say, hey, here's a link. You might want to go spend some time. And then what's the next one? Send Elliot here
Give me more questions.
Yeah.
Give me more variety.
Yeah. He likes to. He's going to pick some dirty questions next time. I already know it. It's I can't believe you. I'm embarrassed. I'm embarrassed. And the one thing we did not do today, you know what we didn't do today?
Pizza.
I got nothing. I got no pizza shop.
Pizza love.
Yeah. All right. So maybe next time. So anyway, guys, thank you so much for joining us. Thank you to Patty, Matthew, Amanda. She's a lifesaver. Yeah, she saved. Some people said she belly flopped on a 3-year-old in a river. Other people say she saved the 3-year-old. We don't know which one it is quite. Whether the 3-year-old might have saved Amanda, it's possible. We don't have video evidence. Jeff, Troy, Arash, Dutch, Tanya, Summer, we had a bunch of people jump on. They're answering your questions. And so thank you guys for doing that. there are still 8 open questions. So if you have an open question, you just chillax. We will answer your question. In the meantime, I'm going to say thank you, and we will see you next time on Tax Tuesday. Send in your questions, guys, at Tax Tuesday to Anderson Advisors, so that Elliot could pick yours. No dirty stuff. No more of this. These whatever these untoward named tax strategies, X-rated tax strategies. We're done with it.
Keep it classy.
Yeah, from here on out, it's only the proper names of tax strategies that we're going to be covering. Now, we'll see you guys in 2 weeks.